This is our 2026 market preview. As you can see, I've got my crystal ball out. So a lot of this will be predictions. I'm going to separate this into two sections. A lot of you guys were just interested in the cool predictions, so I've put that in the beginning. And then if you guys want to stay to the end, we'll dive into a little bit more datas and facts and other takeaways that I see out there. The 2025 was AI driven, a lot of volatility, tariffs, and we'll see what happens into 2026. And where do we sit now? Markets sit at all-time highs, and there is concentration risk growing inside those indices. One thing we've seen is the Fed cut rates. I think it's the third consecutive reduction. By this time, they've signaled a more cautious tone heading into 2026, with them trying to balance inflation with the weak labor market, which is a good sign if you're wanting interest rates to go down, as all of us real estate investors are. I think the Dow rose by almost 1% when they heard that. And you should know, S&P 500 is basically in NVIDIA right now. So if you think you're diversified, you're just pretty much predominantly that stock exposure to that. So I guess like the message here, not giving any financial advice because none of this is financial advice, is if your portfolio is sitting at near all-time highs, this is a good moment to rebalance you back to your original asset allocation strategy. You don't take it from me because I'm not allowed to tell you what your asset allocation mix is. But I think this is where it's good to get around other accredited investors also investing in this way. But we'll start off with this three-pillar framework just to start off with some of the big things that are happening. Public markets, near peak uncertainty, and then the private markets. So we'll define the difference. So the public markets is what you would probably know as going to Wells Fargo, going to Vanguard, picking up some stocks or mutual funds. It's where the public access, the highway of investments. This is what we also call the secondary market. The private markets is when people go directly to the deal source, and that's the primary market. If you want to use institutional speak and sound cool, what we try to do is we try to go directly to the multifamily apartment operator or be it ourselves, as opposed to going through a REIT, which is the Wall Street's version of giving people public access to this through, again, the secondary markets. So let's get the crystal ball out. Again, these are just some predictions, but maybe as I talk through these, it'll be somewhat insightful for things that you're looking at, maybe some things you haven't thought of. But ultimately, we all have to take in so many inputs and make an educated bet. That's what an investor is. And there is always risk involved in everything. Predictions are never perfect, but I think it's important to write some of these things down, as I've been doing for quite some time, and then baselining yourself in a dark room and keeping yourself accountable. If you're one who kind of understands what's happening out there and how they interplay each other, I think now that you're aware of public markets versus private markets and primary versus secondary, these are ideas that I think are pillars to understanding and making good investor decisions down the path, as opposed to being like how most investors are, is they just look at like the chart with what's been doing good the last 3 years. Oh, let me invest in that. That's the worst way to invest. The problem is most investors don't have one. That's a takeaway for everybody here, is to just relook at your asset allocation mix and or come up with one. So prediction one here, we're seeing a valuation-led correction cycle begins. So a lot of the public market valuations are no longer matched with fundamentals, specifically PE ratios, price to earning ratios. The Shiller Cape ratio is above 40, puts us in late stage bubble territory. Market leadership rests on a narrow group of these AI mega caps. On the one hand, this is a little bit different than the dot-com bubble. In the dot-com bubble, you had hundreds of little companies, some of which had, or a lot of which had no revenue, right? Or no profit. Here, the difference is like you have the AI boom happening in maybe 5 or 6 companies that's pulling up the rest of the market. And when volatility rises while fundamentals weaken, the next major move is usually that correction or that downturn. Many investors follow this playbook from a decade ago, is buy the dip and trust the index. But overexposure to these public stock markets becomes a liability once you're already wealthy, right? Because you've built it up and it just deflates away. The key is to know when to walk off the table, right? It's just unfortunate. It's like craps, that damn craps game. I don't like it because I've probably lost more money than I made. But if you think about it, how vindictive that game is, like you keep winning money until the seven comes out to hit craps. In a way, if you're somebody who keeps reinvesting in what has been hot, essentially you're creating overexposure based on your asset allocation mix. That's essentially about playing the game of craps. And you're like, shoot, I've lost every game of craps, lost all my money that I've played. It always ends with a seven at some freaking point. So what do you do to counteract that? You have to know when to take chips off the table or asset allocate back over every so often. And that's the hard part, right? Because we like to play the hot hand. One thing that's happening is public market visibility is weakening and information flow. There's a lot of noise out there, right? This is what creates those volatility spikes and these corrections move quickly. Understand like the blast radius before reallocating. And unfortunately, by not doing anything, you're reallocating, right? As I've said before, a decision to not sell today your stock is a decision to buy it at that price today. Prediction number two, transitioning over into real estate, something that we've been heavily involved with over the years. Real estate is very highly correlated with interest rates. Softer labor markets and policy pressure from the Fed, as I mentioned earlier, is looking like that more rate cuts are coming in the future. So a little bit of a history lesson from summer of 2022, the interest rate shot up quickest time in history, if you want to call it the last 40 years. It wasn't the highest, but it was the quickest time in history. And this is what caught everybody off guard, including institutional investors. Now, what we've seen since then it stayed higher for longer, right? If you compare it with the last interest rates hike where it stayed up there. And then it stayed on a cliff for a little bit. And then recently, the last three consecutive rate cuts. So this is expected to continue into next year. However, from a real estate perspective, and we're keen to this when we look at deals, I'll tell you where my head's at. The Chatham Financial Curve and the CME Financial, these are the rate cap providers that you'll buy rate cap insurance from. These are essentially your Vegas odds people. They predict where the rates are. They've been known to be wrong, right? But they're predicting these Fed rates to go no more, dance around this 3% line and maybe stabilize or go up from there. So what that means is if you've been a real estate junkie over the last 20 years, you probably are a real estate junkie because you've been doing it in this 0% interest rate environment. Now you're having a change of the guards. Howard Marks, great investor, had a comment that the real estate game has changed. So if you're an investor who is looking to acquire new assets into this new world of about 3% Fed rates, I think you need to reevaluate. It's been a change. It's a new generation out there. It's not your grandpa's real estate. Some of you guys are lucky enough to have bought little rental properties or been in deals for 5 years now, 10 years now. That don't count. You can't go and buy a house in Birmingham for $80,000 and rent it out for $1,000 now. Today, that same property is 140 grand. Sometimes we have some old heads that come to our events and say, yeah, real estate is the great. It's been doing for me. And yeah, for sure, grandpa, because you bought it at 50 grand and now it's worth $250,000 today. That's great for you. But what we try to do today is help out new investors and investors in still growth mode buying stuff today. I don't care that the price was 80 grand or you bought it for 50 grand, right? That's superfluous information. We need to know and base our strategies based off what is happening today and what we predict the climate will be in the future. Not to say that we won't do real estate deals anymore, but these are some of the set of assumptions that we use. And it's important to go in with the right business plan to account for this. And I think one thing on all levels, whether it's single family homes or large multifamily or any other commercial property, now you're seeing all the self-storage people and mobile home park people go through their struggles, right? As they're lagging from the multifamily sector. But interest rates impacts all real estate and pretty much all assets out there that you can no longer just buy, hope and pray, right? You can't just buy and hold an asset on a 30-year mortgage or a good 5-10-year commercial note. You have to be doing some value add. And this is why we've also opened up the deal flow to things outside of real estate, because you got to search for more audacious business plans to be able to seek out the same alpha that we once so luckily had a lot easier. The idea is what got us here isn't going to get us to where you want to be. If you're already to $4 million net worth, congratulations. You don't need to watch this video. You're probably good. Maybe just check out the banking content infinite banking stuff or some of these other debt investments. But yeah, to me, if you are still under $2 to $3 million, you got to get going. So interest rates, just to give you an example, how things have drastically changed from a few years ago. In 2021, at the peak of the market, you picked up a commercial property for $10 million at a cap rate of 4.25. But the important thing is the market dropped out 20 to 30% at least, right? In some markets like Phoenix, you're seeing some properties drop like 40%. For some of you propeller heads out there, you guys know that the cap rate is really what drives the price, right? Because it's the net operating income divided by what the prevailing cap rate is. And when the denominator is bigger, like today at 6%, where you used to buy it at 4.25, that's what creates the price lower. The reason why is obviously the debt is a lot higher cost, so buyers can pay a lot less. And this is also why like we stopped buying things after interest rates started to spike because nothing really made sense. Before you could get a nice 7% cash and cash return. If just playing around with the same round numbers, you're at like a 4%. So lower return, but it's much safer because you're buying the thing at $7 million versus 10. That's how institutional investors look at this. But that's the reality and why it's the opportunity to buy today. Other thing is the rental rates are somewhat stagnant right now. Some markets are even negative by 1%. Gone are the days of Phoenix rocking at 15, 20% rents and above, or even good growth at 3% per year. That's not happening anymore. And then here's the mistake. An investor will say, I'm just going to wait till rents start to really get moving 2 or 3% in the positive direction. Well, I'll tell you, when that starts to happen, this same property will not be $7 million anymore. It'll probably be 8.5. So you've lost that safety margin because your basis is a lot lower. And this is essentially going back to my discussion of grandpa puffing his chest over his little rental property. He can puff his chest because, damn it, the guy bought it at the right time, right? He locked in his basis at $50,000. Or in this case, if you were to buy this property today, you'd lock in the pricing at $7 million. Where if you probably buy once the cap rates go down a little bit more because the interest rates are going down, this same property might be 10, 20% more expensive. So where does this upside come from? As you saw in the last slides, just comparing it, the rates dropped 75 basis points, cap rates compressed to 5.25. And even if you have a situation where you did value add the property, you increase the rents or decrease expenses, that's baked into this assumption here. Like the property performance actually got better, but the damn thing is still worth less, right? Because of the market got weaker. And that is the environment that you're in today. This is just a depiction of cap rates are going hand in hand with pricing. So that this is what you saw happen in terms of pricing in that 2021, 22 area with the peak of the market and then that drop off from there. So how does this translate to when we look at real properties? I always like to use these real life examples that we see when we look at deals that come through our desk. You see a lot of people who just pontificate conservative assumptions, blah, 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 blah. But what does that mean? At least this is how you can educate yourself when you look at deals on your own. Like used to be an old rule of thumb would be use $5,000 of expenses per unit per year. Rule of thumb is $5,000 of renovations per unit, and you would see $100 bump in rents, or $1,200 per year, or a 20%, 24% return on investments on your renovation dollars. Now, what we're seeing now is, like I said, in a lot of these markets, rents are stagnant. Some are even negative. So you're needing to put in maybe triple amount of renovation costs. Part of that is inflation too, of course, but now you're only seeing a fraction of the rent growth from that investment. So your ROI, and just like that little renovation is not 24%, it's now like in the single digits. Renovated units often lease slower than classics, and the premiums, which is what these would be, right? When you renovate it up to the premium level, you're just not seeing the rent bump. So you ask the question, like, does it even make sense to renovate these damn things? And a lot of times the answer is no. Like I see a lot of these deals that you guys may be investing in, and they're saying, yeah, we're going to put in $15,000. And I look at their underwriting and they're only using $70 rent bump. To me, that's a BS rent bump. They're really not getting those rents. That's just a small, minute rent bump. And they're just baking it into the numbers there. They're not going to renovate it. They're just going to put the 15 grand into reserves. As soon as they close the deal, they got your money. and they're going to change the business plan. And this is what we look out for, right? We want to go into a deal where the numbers, where any renovation will actually yield rent bumps. We want to see a much bigger gap than in the comps. And this is why we verify their comps too. They're probably cherry picking even to get up to $75, $100 a month with bad comps. That said, they'll probably get lucky because right now is, I think a lot of people believe is the bottom of the market and they'll get bailed out at the end. But my belief is you don't have control over what the cap rates the market does. You just have control over your own destiny. Are you really going to get for $1,500? Are you really going to get that rent bump to happen? And if you do, you really need to get a lot more substantial rent bump, namely $100 to $200 at least per month to even set sail into that venture. A little bit same discussion here, just to digest the numbers a little bit differently, just for your own understanding. Just introducing, say it was $100 a month rent bump. Now you're at 8% on your money. Still, the question is that even worth it? And I think this is what's hard with LPs, right? Like you guys, when you look at a deal, you really have to trust the operator that they're using good comps, which is why we don't trust them. So we always run our own. And then we typically have units in their market and can baseline with their assumptions. And of course, we have access to the more institutional data houses like the Yardies and CoStars. But this is something to be on the lookout for, to double check what they are putting on there. And this is just a sensitivity analysis chart on if you're looking at a deal and they're saying we're going to do $9,000 of renovations on a unit and the rent bump is this, what is the ROI? And to me, if you're not getting at least like 15, 20%, there's just not enough meat on the bone there. But again, the hard part in this cat and mouse game is the operator will use a more audacious rent bump based off some cherry pick comps. And this is where it's hard for passive investors to really get a grasp on what this number is. And I think that's where our value add comes in on the due diligence side. But long term, there's a lot of new supply hitting the market now, but come 2 or 3 years from now, all that's going to burn off and people need a place to live. So I think the short term, things don't look as good, but that's why you're buying it at 70 cents on the dollar today. But once this gets going in the near future, maybe call it 2, 3 years from now, inflation's also going to hit because of tariffs, and you're going to see this dynamic where the supply demand is going to normalize and rents are going to keep going up from there long term. So that's our recap on the commercial real estate where we see things are going to be going. The saying that people were saying back in 2023 when everything was upside down, it was survive to 2025. Obviously, 2025 is gone. So my little joke is survive to 2025. Just kidding. It's 2026, but you're in heaven in 2027. I didn't make that one up. I'm still taking that from the general partnership world there, but that's the thought. Right now, you're picking things up at the great basis. You're starting to see the momentum. You're starting to see the rearview mirror having the bottom of the market. You're seeing values come up, and you're seeing the continuation of more interest rates cuts into 2026. To me, it feels a lot like 2010, 2012. And maybe ask yourself the question, maybe you didn't have any money back then. Maybe you were just in the stock market. But where were you? What was your visibility into or exposure into real estate back in 2008 to 2012, right? Because if you weren't into a deal by 2010, you missed that huge bounce off the bottom. Okay, switching gears here. Prediction 3, retail capital floods private markets. So we defined these terms earlier, but again, the private markets getting direct access to deals, that direct source idea, cutting out all the financial middlemen, financial planner, their promotes, all that stuff. The US private market allocation is predicted to rise from 100 billion in 2024 to 240 billion in 2030. There's a trend to be aware of there. High income earners want less volatility and more cash flow from assets tied to real fundamentals or real businesses, as opposed to the detachment of owning the institutional public stock. A lot of these channels are like Merrill Lynch, Vanguard, Schwab, Chase, Bank of America, those public markets inroads, 30 million flow in the last 16 months. And why do these people do that? They want stability, tangible value creation, and they just want to chase yield. And there's a lot of platforms and due diligence tools and AI. They're improving and making this a lot more accessible. And this is making us allowed us to, when we see deals, a lot of us is for us, it's relationship driven, right? We know the operator personally or have a personal one run of connection away from them where we get an introduction. Our next step is to do the underwriting, the due diligence, and based off our experience and knowledge. When it's multifamily, it's an easy shift for us. But this is where once investors experience this direct access, the primary source, I don't see how you really go back from then. So the prediction here is I think 2026 is a year more and more everyday investors start to behave more like single family offices, where previously the institutions, the Merrill Lynch's, the Vanguard, Schwab, Chase's, Bank of America's, they wanted to gatekeep this from you guys. Prediction four here, baby boomers are transferring their businesses, they're retiring, and a lot of them don't have any succession plans. They own these small to mid-sized companies. I'm in EO and Vistage, a lot of family owned businesses there, and a lot of businesses where the owner is in their 50s and 60s. And a lot of these guys are financially independent. So they very well could just pull the plug in early 50s if they wanted to, because they got enough money. This is the idea of acquiring businesses or micro PE, which we have gotten involved in 2024. We started our online business M&A fund. It's closed right now, but we'll probably open it again in 2026. The idea is invest in companies with real cash flow, profitability. So not venture capital, angel companies where it's just a kind of a pie in the sky, unproven concept, but you go into investments that it's already has an income and expenses and clientele list and established operating system. This took me a long time to conceptualize for myself and to get into this world. First, it's very much like apartments because when we underwrite an apartment or you guys send us a deal to look at, which by the way, we have the review service at thewealthelevator.com/review if you want to take advantage of that. We get the P&Ls, we get the rent rolls, we get the raw financials, and we throw it into our own analyzer and we analyze it. Typically, you'll get 2 years of P&Ls and financials, right? So just like a business, you can get the same thing and you can extrapolate out, all right, we see how this thing is running in the past. In this case, you can look into the past for a prediction of what's happening in the future, and you can see seasonality trends and long-term 3 year, 6 month moving averages. This is a way that the professionals evaluate the valuations of companies and now acquire, or in our case, invest. BlackRock, those guys, those big guys will allow investors to do it, but you've got to invest like multi-million-dollar check. They typically only work with institutional investors, and them and other companies like KKR have perfected this model and now become institutionalized, where unfortunately the retail investor cannot get access to it with $100,000 or less. So I think that the key to that is you got to have a relationship or verify the operator involved with it. Real estate, the world has changed, right? Like we do not believe interest rates will go down under 3% on the Fed rate I'm talking about. So I think that's like I don't know what that is for residential. I think it's usually plus a couple points, but I'm talking the Fed rate at 3%. I don't think it's going to go under that. So we're in the future, we have to assume that we're going to be in a different climate. Now, Trump could get his Kevin in there and as the next Fed chairman and drop rates to zero. But we all know that what's the saying, taco? Like what he says, maybe a fraction of things actually happened. Maybe he can push it down to 2% based off his will. But at this point, we have to assume that we're in a tough interest rate environment, which is not going to bode very well for real estate investors out there. We'll continue to look for the best opportunities for the tax benefits. And for that, I like real estate in my portfolio, and that's what I understand best. But we've been pushed out of our environment out of necessity and now into private equity. So other predictions here, the inflation, they say it's trending down, but I think long term, a year from now, I think it's going to off to the races again. And I think this is where if you bought that apartment for $7 million that I mentioned earlier, I think this is where you start to get the benefit of inflation. That's it. I'm speculating here, but I think all those signs point to the monetary policy running away. And then there's also a lot of conspiracy theories out there of swapping out the money system, going to a US backed stable coin, things like that, that also contributed to this narrative. But I think That's my prediction here. Inflation will run rampant again. So those people who are sitting in cash or their online savings accounts are going to be the losers when that transition happens. Unless you get into investments now, you're not going to be having that upside exposure to when that happens. Single family homes have not had that correction that multifamily and commercial real estate has because they're 30-year mortgages. Commercial real estate is more bought off of, on average, 5-year terms. So when you have a price drop like that, you have people having to refinance or forced to sell, and that's what creates the drop in prices. Where single family homes are bought off of 30-year amortization, so it can bridge over these gaps. But you're already seeing the dynamic of a lot of people who are in these really sweet mortgages of under 5%. They're not going anywhere because they can't afford the house that they live in today, way more monthly payment because of where the interest rates are. A lot of people just can't afford, the younger people. And don't get me started with the Gen Zers who can't find jobs now, entry level jobs, because AI took their jobs. Right? AI is taking all the entry level jobs, which is sad. I'm empathetic to it, but that's not my problem to fight. I'm an investor. I'm going to do what's best for my family, and hopefully you guys come along and you guys do what's best for you guys too. Then AI taking people's jobs, unless you're a big business owner, I don't think that's worth the effort. So that's it. That's my political talk of the day. Moving on. Hospitality, I think that's very cyclical. We're talking Airbnb. You're starting to see, I think Maui just made it the other day where you cannot, there be putting the axe on all these Airbnbs. So you're going to see a whole bunch of units flood the market. I think this kind of has a tie-in with the single family homes. A lot of people have these short-term rentals out there, and there's dwindling demand for that as you start to run into a weaker economic cycle, softer labor market. Remember, Airbnbs is a fun thing. It's hospitality. It's when times are good, people go on vacations. When times are bad, they do not. So it's a very feast or famine. And when people realize you have all these like millennials who bought all these Airbnb to be millionaire horses out there, start to realize that the market, the macroeconomics aren't on their side, they're going to have to be able to fire sell. And that's what's going to also create downward pressure on the single family homes. The third thing here, the private credit funds. I think that there is some growing risk in that area. So a lot of these private credit funds invest in a lot of multifamily deals as preferred equity, as once was it was thought to be a safe position. But when properties go down in 30% values, like we saw, that threatens a lot of those preferred equity positions that typically sit between the common equity and the senior debt. Right around, if your common equity is your top 20%, that's when the properties go down 70%, it definitely eats into that tooth enamel there, if not eats it all up. So that's something to be aware of. I don't know if you're just a retail investor, I don't know if that really impacts you right away. I'm just saying to just be aware of it because you may see some high headlines of this come out this next year. We've already started to see Barron's cover that a little bit. So I would probably label that as a potential black swan event. For all we know, hopefully, cross our fingers, it never really comes to fruition, as most of these don't, but just something to be aware of. So the AI and then the AI startups, I think a lot of the deals that we look on the venture capital side are just wrappers, is what the term is. So it uses ChatGPT or any other LLM as like the backstop for some cool solution. I will admit, like some of these solutions are pretty cool. Don't really want to mention exactly what they do because I think I'm under confidentiality, but basically it's not like the underlying technology of the LLM, it's application, or again, to use that term, wrapper of that technology. So where I am bullish, multifamily, especially workforce housing with weaker job market, slower economy. The next few years, like I mentioned, there's still a lot of new supply coming online. I was just in Phoenix about a month ago. We stayed in one of our units, and next door there used to be an empty lot. Now there's like a brand new Class A 200 unit apartment complex next door, and they're giving away 4 months of free rent as concessions. So for the next 1 year, 3 years, I think you're going to start to see that supply burn off. And then what we know is nobody's really building now or when interest rates were high. So there's a void of new supply hitting the market. So that's what creates that upward pressure on pricing on rents. Some would say it's like, why the heck do they have to be so bipolar? You could say that a lot about a lot of people emotionally, but it is what it is. That's just how the world works, right? And that's what we're going to see here soon. But long term, the dynamics are good. And so what I've said before, what I've learned is you try to invest in things where, 10 years from now, with that larger time horizon, you are fairly confident that it is still going to be in high demand, right? In America, which is have a high population growth, especially in the lower middle class. I've got some other graphs in the second half of today's presentation where I'm going to go more into this, but select office conversions, although they're tricky to pull off. Triple net commercial real estate. But then again, triple net commercial real estates, you have a lot lower return on this, right? So if you're still in your growth mode, I would question if that's what you really want to be in. Energy and infrastructure because of the AI trend. And then these essential businesses that or especially diamond in the roughs where you have a situation where a good operator needs to expand or acquire somebody who's retiring. What I would recommend is a pivot from these high flying companies that have been doing well and reallocating your own personal asset allocation mix and finding things that have durable fundamentals behind it. So if you guys are seeing deals out there, I'd love to take a look at it. I got to get this approved by legal, but I was like, if any of you guys find a deal and we end up pursuing it, we'll give you like $1,000, right? That's not officially out there, but at least that helps me get more deal flow, right? But if it's from your normal podcaster people out there or your retail internet forums, I've already seen them. I got a list of 800 of these deals where the assumptions are all whack and the underwriting's all whack out of it. We want higher quality deal operators or what we call the family office quality deal. But yeah, I think if you go through the process of the deal review service, I think at the very least you'll get the understanding of what do I look at in the underwriting so I can be a better investor and identify deals better that way. But if you're new to the group, you can access the 12-month masterclass to get a lot of the fundamentals at thewealthelevator.com/master. If you're not in our community and you want to get access to our online community, which we're going to be kicking off early in 2026, you can join thewealthelevator.com/club. And if you ever want to come to events, you got to have that onboarding call with myself so I know who you are. We've got the Hui 8 Investors Retreat coming up here in a bit, and we'll probably do it again in 2027. But I want to understand like what are your goals, right? For some of you investors who we haven't talked to in the past year, reach out, shoot us an email. What are your goals in terms of these three categories: taxes, cash flow, and equity multiplier or equity pop? Remember, you can't have all three of these, right? People will say, I'm looking at this deal, it's a 120% return investment in 3 years. You're giving me 9% cash flow as a pref, and I'm getting 100% bonus depreciation. I'm like, go ahead and invest with them. We'll see you in 3 years. Can't have all three. They're somewhat mutually exclusive. Like you can't have cash flow and equity multiplier at the same time. It's like the scope, schedule, budget triangle. You can't have all three. You can't have it cheap, fast, and high quality. So you have to tell us what you're looking for. What is your adjusted gross income? If you're married, file jointly. If you're above $380,000, you're in a higher tax bracket. We start to chip away at that one first. Taxes might be your first low-hanging fruit. If not, then it's strictly getting into deals. And if you're higher net worth, you probably want cash flow. If you're lower net worth, you're willing to defer cash flow for more equity in the long term. It's real basic. I think everybody's situation is different. It's not a conference. It is small group workshops for the most part. I think I do a good job curating the table topics. Most times we're just walking through and on our Circle Island tour of Oahu, a cool place in a very immersive environment where people let their guards down. They talk about asset allocation mix, their family values, what they plan to do with their kids, how they're teaching their kids how to do this stuff, all in a paradise. If nobody has any questions, what I'm going to be doing is going into the second half of my talk today. The first half was mainly to be look into the crystal ball predictions, somewhat fun. This one is a little bit more like macroeconomics. What are the trends pointing to? The big ones, technology, the AI is upon us. Crypto is another part of that, maybe also leading to the bubble too. But big part of if you want to play this is the energy sector too, which is what we're going to be talking here about in a bit. Bioscience, something that I think because of people drug addiction, people want to live longer too, fertility. It's something that I see as a trend, although this is something that definitely I stay away from personally because I like to invest in things that I have some either relationships in that sector or have a personal working knowledge. I'm not a doctor. I don't know the science behind it, but we operated a lot of real estate. So that's why we do real estate. I understand digital marketing agencies. So that's why we did a roll up of that. The other thing that we're looking at is, or I think that's coming up to be on look at, is the real estate sector. We talked all about that in the first half, so I'm not going to belabor that. Manufacturing, I think a real impact is on tariffs moving where people manufacture things around. I think Trump was successful in bringing at least some manufacturing back to America, but I think this may also exacerbate or accelerate a lot of trends you already saw, just like how the pandemic accelerated a lot of trends, work from home, e-commerce, etc. Tariffs accelerate a lot of other things and potentially maybe advancements of 3D printing and technology and robotics. I think you're already seeing Amazon get on the train of eventually just having all these warehouses with a bunch of robots and not having too many people. Another one is defense. You're seeing a lot of wars around the country and a lot of proxy wars. So that could be another place for investment. But just read this as ideas to look down. Maybe you weren't aware of these things, but hopefully this maybe piques your interest. So all of us are investors, have one thing in common is that we're all lifelong learners and curious on how the world works out there. So the first to break those down, AI is the future. This is the data behind it. A lot of venture capital just plowing into various AI backed projects. It's a joke. You cannot have any type of startup deck without the word AI two or three times in it. It hasn't quite exactly turned into the drinking game yet, if not everybody would be drunk at this point, but everybody is using that, whether just putting it as a buzzword on their pitch deck. But I think it is in everything that we do. Certainly has changed my company quite a bit, and especially how we do due diligence and all these deals too. So there's a lot of ways you can invest on this AI trend, which I think we can all agree is here to stay, and it's going to be a monumental shift moving forward. I can't exactly say if it's a bigger shift than the internet came or when factories came, but I know it's big. But there's a lot of ways that you can play this. I think data centers always comes to mind, but the problem is there it's hard for a retail investor to invest directly into a project like that. I think if you wanted to play that, you're going to have to play in the secondaries markets on that, which is again sloppy seconds, your public markets where you're going to have a lot of fees going to the big guys on that one. So you're not going to get like a one-to-one signal on your return for that as you would more directly. That's the name of the game on the infrastructure investment, which is the cooling towers, water supply, energy grid, data centers. I would say it's not written on here, but I think nuclear, this is what's going to open the world for nuclear to finally come in. I know most people hate nuclear because unfortunately everybody thinks of Homer Simpson operates all the nuclear power plants out there. If you look at the data and you have an open mind, it's pretty safe. So my hope for mankind is that I think this propels nuclear forward. Some other things to think about: natural resource investments, bioscience, defense sector, fintech. I think this is something that we have a look in based off our expertise is fintech and prop tech. We've had a lot of venture capital firms come to us and say, we pass on a lot of these prop tech, fintech solutions because we just don't know much about the industry. Very similar to like how I don't know consumer product goods, right? Like soft drinks, those things, you see them all the time, this deal flow. Or as I was mentioning earlier, like healthcare stuff, like I don't understand that. So I just pass. Like it comes down to like, what is your strike zone? If you're using a baseball analogy, when I used to play baseball, I didn't like the outside pitch. So I just didn't swing at it. Yeah, sure, I get struck out sometimes and I miss some pitches, but I know what are my pitch, which by the way, I like the high ones. I like the high ones. Think up. So I think the way we're going to play this is in the energy usage is going to go way up because of AI. There's, I don't know, like I heard something the other day. I don't know if this is true, but they're like, it's such a shame that you have to use all this energy to ask a stupid question that you could have just Googled or asked your friend for because people are just too lazy and type it into ChatGPT. But yeah, the energy usage expected to rise to 3.3 trillion. 2.2 trillion of that is expected to go into clean energy. So what this is saying is most of the new investment is going into like the green energy stuff, but it's stupid because the green energy stuff barely produces any of the world's consumption of it. In reality, if you look at the data, those I put them in dark black and gray because it's dirty. That's how still we make the majority of our energy. I personally would like to see nuclear increase from here. So KKR estimated fuel consumption. KKR is a very one of the top investment firms out there, and you're seeing where they are investing their money, where the money is their mouth at, is only 5% in biofuels. The rest, 95%, are in all your gray, dark, dirty energies. Once BlackRock, here's what they are investing in. They got 40% in renewables and the rest in the dark stuff. They have 25% in utilities and grid infrastructure, which is somewhat neutral. Berkshire Hathaway, Uncle Warren, he is investing in only 10% renewables. The rest are just the dirty stuff. And then what we want to tease into is like this oil and gas producers section is the way we want to play this trend. So is fossil fuels undervalued right now? We think that the friendly administrative policy around drilling, Trump has always said drill, baby, drill. He says that, but he has done nothing yet to really put in incentives for people to drill, baby, drill yet. Maybe you put that in my prediction. I think in the next year, we might see something really help us who are involved in these types of oil and gas projects. And this is new to you. Oil is used for pretty much everything that we have out there, even your guys' Teslas, and then especially the energy to produce the battery. In a weird roundabout way, it's all comes back to oil. And then the plastics is all oil. When you pump for oil, you get the gas that comes out. That's natural gas. That's typically what powers power plants out there, your heating. So it's all around us. Like I said, going back to the old graphic here, you can see by the graph, that's looks like 80, 90% with a fraction of the investment going into these industries. The other reason why we like this is the good tax advantages. We've got some other videos on it. We brought in a tax lawyer to talk about intangible drilling costs. That's usually powers your first year. That's a big win in the first year from a tax perspective. And then depletion allowances. So if you're in the highest tax bracket, maybe just reach out to us and set up a call to discuss some options in this sector. And then this is a comparison between the energy sector stocks versus the market. And so you're seeing a lot more healthier metrics here in terms of price to earning ratios. In the energy sector, you're at 8 to 10x. S&P 500, you're sitting at a 22 to 25x. So a lot more bang for your buck in terms of like positive financials in the energy sector. And it cascades down from dividend yield, free cash flow, and then how much debt these companies are having, which essentially alludes to, are these companies undervalued in comparison to the market? Now, digging more into commercial real estate, as I mentioned earlier, we're starting to see this comeback to break it down per sector. Office, I still think you're going to see that weak demand linger on. I do think there was a fundamental change on how people commuted and work from home. We're seeing a little bit of a bounce back and of course a rebellion against that from employees to employers, but I still think that there's a high risk of higher vacancy for longer. I think it'll naturally work out as you're seeing less and less newer buildings getting built and just waiting for that demand to catch back up to this new normal. It's interesting for me to see people who used to specialize in the office sector. Some are out of business, but some have pivoted. And for me, it's very inspirational because the saying is what got us here isn't going to get us to where we want to be. After 2022, 23, there was a fundamental change when interest rates skyrocketed, quickest time in history. And I think everybody needs to recognize that how you play it is up to you, but everybody needs to recognize that fundamental macroeconomic change. And that's what we're talking about here is macroeconomics. Industrial logistics, likely to remain strong. You still got to get things to people. I think some risk there's oversupply in low barrier markets, rising construction costs, and obsolescence of older stock. So that dynamic of older Class C properties in that sector just decaying and being retired. Multifamily residential, the outlook, steady demand, especially in growth markets and in middle rental segments. New supply may moderate. Forecast completions, about 430,000 units in 2026. And then that goes down to 360,000 in 2027. So they're saying may see recovery start at the end of 2026. But again, you got to be in the deals prior to that because that may mean the difference of picking that property up that I mentioned for 7.1 million versus 7.9 million, right? You're losing that safety margin right there, and your debt service is going to be a lot more once that happens. The risk to watch out for is rent growth may slow. And as I've mentioned that earlier, especially in household formation or wage growth weakens, supply risk in overbuilt markets. So that's why we've been staying away from the primary markets like Phoenix and Austin, and we've been going to more of these tertiary markets because in the peak of the build cycle, you didn't have a rampant amount of new supply being built and hitting the market today. So I think that there is some safe refuge in those markets. At least like the cash flow is stronger out there too. A retail sector, retail may struggle because of more e-commerce trend. I think the Black Friday numbers came out again, and that's always a good benchmark because it takes into account seasonality out of it, compares year by year. And we're seeing that general trend to more and more e-commerce. Senior care, obviously we talked about earlier how the baby boomers are retiring. They're not yet using these types of services. The majority of the baby boomers is what I'm saying. So it's not coming quite yet, but I would caution everybody if they think they want to be an assisted living operator, think again. There's a lot of operational risks. You're not really running real estate, you're running an operational business with lives at stake. So I'm a passive investor in one of these, and I think, yeah, we're up to 100% occupancy there, but it took a while and there was a lot of bumps along the way. But I don't think we saw that macroeconomic tailwind power us throughout the project. So that's what I'm saying. Like anecdotally, I think you're seeing that tailwind maybe come 5, 10 years from now. It's still a while off. I think the risk to be looking for is zoning complexity. So when you look at those types of deals, just making sure that the municipality has a good path forward on that. If not, it could just block your project and screw up your timelines. These are like that coincide with the U-Haul report. This is the top cities, metros for attracting inbound moves in 2025. So we don't know what 2026 is, but you can see the general trends where people's going on people's head. Number one is Myrtle Beach, South Carolina, Wilmington, North Carolina. Number two, Ocala, Florida. Maybe that has, I know there's a lot of retirees that are moving out there. That's just north of the villages, that retirement community. Raleigh, North Carolina has moved up slightly. Greenville, Spartanville, South Carolina. So the trend on those are lower priced areas, maybe just a matter of rebalancing. Dallas, Texas was the next one that came on the list. Boise, Idaho was next, Knoxville, Tennessee, and then Houston, Texas, specifically Cypress, zip code 77433. Of course, these are where people are moving in. So population and job growth are the two biggest drivers, in my opinion. We tend to look at like the rent increases per year as more of an indicative composite statistic as opposed to just population growth. I think these are important things to be account for. Of course, I think at Dallas, I got to look at my data, but just because it's on this list doesn't mean that there might be a whole bunch of new supply coming into Wilmington, North Carolina, for example, and that kind of negates it off to where you should actually be investing. And that brings us to the next slide, which is the delivery slide, which I was just talking about, right? Which are the markets with the most supply coming online, which on the one hand, developers wouldn't be building stuff there unless there was growth. If there's growth, this is going to throw rents out of whack as they get absorbed for a few years in the future. One thing I don't like about this data, and I'll just point this out because it's a pet peeve of mine, is like number one is Dallas Fort Worth with 60,000 units. Some of these markets aren't exactly the same size of population. So I would always like to see these overlaid as more of a percentage of current unit stock, right? Because I don't know if 60,000 units is maybe 2% of the current units in Dallas versus the next one here is New York. In New York Metro, it has 46,000 units under construction now, but for all we know, that could be 10% of that. I don't think so, but I'm just using it as an example. I'm sure I could just have ChatGPT do this for me, right? But that's where I say, like, when you look at some of these data, and I got this data from Yardi, which is more of an industry newsletter on December 2025. This is more of a better look. That's why I use this particular one for you guys. When you ever look into a market, a Yardi CoStar report will typically have the pipeline of new supply coming online. Number one, Dallas. Number two, New York. Number three, Phoenix. Number four, Austin. Number five, Charlotte. Number six, Miami. Number seven, Atlanta. And number eight, Los Angeles. So that's what I was saying like earlier. Phoenix and Austin, they're just getting beat up with new supply coming online out there. One thing I'll just say, like the other day, I saw a statistic on where rent growth is coming. And to me, I look at rent growth because I think that's indicative of population growth and supply and demand. So I put more emphasis on that particular statistic. So New York is actually increasing in rents out there. New York is actually on one of the highest rent growth markets, which if you line it up with this data fact with a lot of new supply coming online and rents are still going up, that's an extremely good sign for the New York Metro. But I think that's what you're starting to see happen is this kind of trend within a trend of the primary markets. Like when the pandemic happened, people moved out of San Francisco, Los Angeles, a lot of these densely populated metros like New York. And then they went away from that and they went to the Sunbelt states. And then now they're coming back from the Sunbelt states to the major metros like New York, LA, San Francisco. And as more of an investor who's now been through two of these market cycles, I've just been a little bit jaded to this. Some of these are just, they just go back, they just teeter-totter back and forth in a cycle of 4 to 5, 6 years. Just more like the reasoning behind some of these top growth cities. Projected top US growth cities in the next several years, Houston at top, then Dallas. So yeah, maybe this confirms what I was saying, right? Like in the pandemic, everybody was moving out of the major metros, going to Sunbelt states, and then now it's going back, and then 2026, 27, it goes back to the Sunbelt states. Yeah, right. Houston, Dallas, Phoenix, Austin, Charlotte, Raleigh, Myrtle, South Carolina, Greenville, South Carolina, Knoxville are your top projected top cities of growth in 2026, 2027. Private debt continues to be a winning play as there are other anticipated over-leveraged debt funds. As I was mentioning, there could be some trouble brewing in the private credit space. And this is why we've tried to get more involved in here. To when other players drop out, that's when we can take advantage more. And then you'll see more discounted notes hit the sector at that point. Base focused investment that looks for a deal and price. So that's what I was saying. Like using that example I used in the first half of that $10 million property that's now worth 7.1 today. You have some uncertainties with stagnant rents today, but when the rents start moving and inflation starts brewing, the price of the property is not going to be 7.5 million anymore. At the end of the day, if you take what successful people have done, the common thing is they just happen to get involved at the right time. Sometimes it's better to be lucky and come in at the right time than to be smart. So the next topic here is single family homes, some volatility in coastal and Rust Belt markets, but no doomsday here. I'm going to hit you with a bunch of graphics here. So this is probably better to check up on the video later on, but this is delinquent loan rates over time. We're seeing that seasonality in there too, but you can see how it's been trending. I would say take the pandemic out of it. That was quite the anomaly, but you can see how things have been trending and probably regressing more lower. Some data factors contributing to single family homes. These are some things that you may want to add to your own due diligence or your own identification of markets. We try to identify the best ones and then, of course, underwrite that specific deal with raw financials. But I think it's good for you to also develop your own buy box with some of these industry publications or data sources to come up with your own conclusions. Based off that, here are some other markets. A lot of these we've talked about in the past, Orlando, Florida, but not saying that they're good places to invest, right? Because they may have some other disqualifiers such as hurricanes, etc. Although 2025, some people say it was a bummer year from an insurance standpoint. There were no major hurricanes that hit US. And for that, we actually saw some insurance go down a little bit, which I think reversed like a 5, 6 year trend for us. Here's some likely laggers: San Francisco, Seattle, Los Angeles. So these are your highly populated blue states. Coastal Florida micro markets with insurance stress. Despite strong migration, insurance availability costs can flip deals from penciling to not. Rust Belt cities with persistent outflow, thin demand and lower liquidity raise hold and exit rate versus Sun Belt. So people are generally still moving from the colder northern climates to the southern. It's still the major trend. High vacancy downtown condo cores, so has a lot more investor softness in there due to HOA insurance assessment surprises can impair returns there. So I know some of you guys own condos as some of your earlier, cheaper investments that you've gotten into. So these are some things to be on the lookout and may mean the reason why to sell in 2026. And then you sell, you're going to have a capital gain and depreciation recapture. In the e-courses, there's a tax section. But yeah, if you guys are looking to do a 1031 or anything like that, just reach out. We can talk through options. And then the last thing here to keep in mind, overbuilt suburbs with long commutes, vulnerable if rates stay elevated and gas commute costs bite. Right now, oil prices are lower. That the war in Ukraine is still going on, which I think is putting a damper to oil prices, which my theory is Russia's kind of dropping their prices lower to sell it off their primary markets and their normal channels. So that's what's keeping prices lower. But I think it should pick back up, as I say, with the AI trend too. I think that's a bigger trend than the war or impact to oil prices. But it's something that I'm learning, right? And if you look at major wealthy families, they have exposure to energy and oil and gas and things like that, if not just for the tax benefits. And then keep in mind, every asset class goes through market corrections and there's an exuberance expansion, and then it goes to the hyper supply side and it goes through a recession and then it goes back up again. We never know exactly where we are in the timeline until the dust settles several years later. If you look back at the great years that 2010 to 2014 were for real estate in particular, or even you could probably even say for the stock market, that confirmation is really never fully cemented until 5 years later. And I would probably say we're still in that dust period where we don't know if the bottom was hit last year. And then that's what makes investing difficult, but that's why you diversify into multiple asset classes that are not correlated. Unfortunately, most people there maybe feel like in different things, but it's all impacted by the equities markets out there. And they're all essentially in one market cycle. So when things go down, everything goes down. Interest rates has a big portion, and this is the Chatham financial curve. Essentially, you're seeing that general trend of kissing that 3% and staying there long term, where we're coming out of this decade long, maybe even longer than a decade of 0%, right? And this is what made real estate go and those types of deals. I call myself lucky to be involved in a great asset class during the great time when there were tailwinds behind us. But now those tailwinds have become, they were headwinds definitely up here, but I think they're coming to be a little bit more neutral. Yes, I understand real estate and that's what we are confident in running, but you want to invest in things when you do the SWOT analysis, strength, weaknesses, opportunity, threats, where you truly identify what those are and you make the best bets. Then again, you're never going to put everything in one asset class too at the same time. Here's the pricing index for multifamily. You can see that run up in 2021 and then the crash down. You can see a confirmation of a little bit of a bottom there. Look at it from a decade long, several decade long trend here, right? Here are commercial real estate prices for United States. This is more of a percent change per year as opposed to absolute price. So you're seeing a price correction across the board of 10% to the downside at least. And this is year after year, right? So you got to say it's cumulative, right? So if it was 10% plus 5, that's how you get 20 here. That's how you read this chart. And this is the 10-year Treasury versus the Fed fund rates, how they intermingle. I think this is getting a little bit more technical. Some of you guys who've lived this through with me the last several years, it's definitely something that you will never forget. And now is the time to learn because we're all interested in it now. Unfortunately, a lot of the lessons learned, you don't really need to pull out your notepad until 2032, when like supposedly the next correction will hit, right? These corrections typically are spaced out anywhere from 6 to 12 years is what they say. I think in crypto is the only exception because everything moves a lot quicker in crypto. So you have a major correction every, like 3 to 5 years in that thing. But overall, like I said, you invest in things that you think you're bullish on in 10 years plus. I'm not particularly saying real estate is that, but I'm just saying like whatever you invest in, trying to pick those macroeconomic trends that will power it forward. Specifically, real estate now, you're starting to see this oversupply of inventory, and that'll taper off significantly with tertiary markets first. That's why we're in those first, and then the secondary markets. And the rates will continue to be a challenge as long as the CPI continues to be high. But this might be the new norm, and the institutions are buying commercial real estate aggressively. Now, I don't know if the pros know something that we don't, but that is what they are doing at this point, putting their money where their mouth is. And apparently, as we saw earlier, Warren Buffett, KKR, and Blackstone have a significant portion in those oil and gas sectors as opposed to green energy. Here's some other comments that I just cut and paste from other industry reports. I'll just read the highlights here. Multifamily sector continued to defy supply shock with a 0.2% effective growth rate. Completion is expected to slow down in 2025. We anticipate a declining vacancy rate and larger rent growth in the year ahead. I'm going to skip over office and retail. You guys can read that later. But this, I think this is why I am bullish on multifamily long term. The population, especially for this asset class, is growing. The lower middle class, the rich are getting richer, the poor are getting poorer. And that split between the average monthly rent versus them buying a new house, it's just getting wider and wider. You're seeing that multiplier in different markets. Obviously, Los Angeles, Austin, Orange County is just off the charts. You have other markets where it's a little bit more affordable. People are going to live where they want to live, but they just can't afford the houses there. You're seeing this long-term trend of home ownership rates. One time it was going up, but like historically lower than where it was. And what happened in 2000, I think 2005, 2008, that George W. guy had this belief that everybody should own a house, right? Which ultimately created this situation in 2008 where they're just giving BS loans to BS borrowers, right? The subprime mortgage collapse. So I think that is somewhat of a testing of the market at 67, 68% percentage of homeownership rate. Even if you're not a doom and gloomer or pessimistic for the future, I think you're seeing where people's salaries are in the future, and it's going to be harder and harder for those guys to own their own houses, at least for them. Everybody wants to own their house. Different story if you can afford it. So this is a depiction of the new inventory that is coming online in the dark blue, and then the teal is the absorbed, so the stuff that's getting filled with new tenants. So you're seeing the steady supply of this ramping up of the new supply coming online. And where this is coming from is, remember in 2022, right about here, and going into 2023, interest rates were skyrocketing. So we had a successful project where we refinanced. I remember we got out of the construction note November in 2022. And I was like, oh, geez, we got to do this now, right? Because the gap was closing. Like the rates had shot up at least 3/4 of a point twice, I think, at that point by the end of 2022. Shortly there, maybe 2023, you didn't build anything. So that's why you're seeing that gap, right? See, people stop building. But these properties take about 2 to 3 years to be born, right? Where babies take 9 months. So that's why you're seeing there was a lot of new money coming online here and stopped here, but you're going to start to see this coming through to 25, 26 on this chart. And this is a slide we refer to quite a bit. It's a little outdated here, but it's supposed to be a prediction of your peak annual deliveries based on different markets. Let's just take Dallas, for example, because I think it's in the middle of the pack. But they're saying that middle of 2024 was the peak of the deliveries, and you're going to see it declining vacancy here. And then probably around the second quarter of 2025 is when you're going to start to see more positive rent growth because the declining vacancy out there. Declining vacancy is good. Rent growth is good. So this is why all markets are a little bit different. It has a little bit different dynamic with how long it is. Every market is a little bit different. I would probably say like Phoenix, and I gave my anecdote of that 200-unit new build apartment complex right next to us. They're probably one of the last markets to recover, and I think this graphic confirms that. Their peak annual deliveries isn't happening until late 2020, where others have confirmed that point. So they're maybe an entire year behind or more behind a Dallas in terms of recovery. Still, there's been a bit of a trend for institutions to buy more single-family home stock, but still the estimated share of the single-family home market held by small mom-and-pop investors under 1,000 homes, still varies between high single digits to 20% in a lot of these markets out there. Still a minority portion of the housing stock is owned by the average investor, which I would say would be us. The state of the economy. 2025 has been a year of stabilization rather than expansion. TR Economics, they're predicting a nice little run up in 2026. So they're saying for especially business owners is to get ready with hiring and expansion plans. Inflation has cooled but remains sticky in housing and services. And then GDP growth remains subdued but positive. And it's showing that customer resilience, right? You're seeing that in the Black Friday numbers and then people spending money, Christmas, holiday stuff. Labor market is tight, but moderating. But the important thing is wage growth has flattened. That's been a long-term trend and why people can't really afford houses in the future. And the Fed is expected to cut rates multiple times in 2026. Again, the best place to see that, I think, is the CME Fed Watch tool. There, if you click on the tab where the next Fed meeting is, you can see the percent odds, or what I call the Vegas odds in a way. But I think that the key takeaway here is like good investors don't like volatility. And I think that's what we're in. We're not in a boom or a bust. We're just a slow, steady recovery cycle. And that's creating a healthy foundation for a healthy reset for investors, or to enter into projects where you take your own faith in your own hands, you have a business plan, and you can build something on solid ground. Hopefully cap rates come down and the market appreciates, but try to underwrite the deal where you assume that doesn't happen. I think we're starting to see the bottom forming in commercial real estate, especially prices are roughly 20 to 25% below the 2023 peaks. Cap rates have begun early compression in select markets, which means the cap rates are coming down, which means the prices are going up. New construction starts are at 40-year lows, because right around 2023, you would have been crazy to enter into a construction note and start construction. So that's why you're seeing this low in construction. So this will set up a major supply shortage in mid 2026 and beyond. And that's when the rents start to go from there. The credit markets, the bond markets, interest rates are still relatively high. I expect that to continue. But I think the thing that I look at is your institutional players, your Blackstone, your Brookfields, your KKRs have steadily re-entered and signaling that confidence in a bottom, or at least from the institutional front. So the key takeaway here is smart money is quietly buying again, and this is the value entry window, not a seller's market. Yeah, 2024, 2025 correction brought a lot of investor fatigue, but I do see appraisals inching higher. I saw a couple of our properties when it got appraised in 2024 and more recently later in 2025 came up 10, 15%. I think that's definitely more than that fudge factor you have in there. So I definitely see that anecdotally within our portfolio. And I think there is still a lot of fear, right, out there. But that's historically when the best deals are made. And then you look at like the big guys like Brookfield and other private equity groups deploying billions into distressed multifamily. And then the last thing I'll say is like Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. UBS in 2024 surveyed 320 single family offices. So these are wealthy people, right? I would say 50, $100 million net worth and above. What do they have? They're managing 600 billion. What does their portfolios look like? To give you an insight into what do they own, 20% equities, 16% fixed income. And then this is indicative of wealthy families, right, that are not really in growth mode. But still, they have 22% in private equity, real estate at 10%, and 78% plan to invest in generative AI projects as at least part of their portfolio. And what you're seeing from some of these families is this barbell portfolio where they have a lot of stuff in fixed income and small portion in more asymmetric plays where they can take advantage and get the upside potential there. If you guys want to jump on a quick call with myself or my CIO, Elisa, talk about your portfolio. Again, let us know what you're looking for. Either you're the tax advantages, the cash flow, or equity appreciation. Let us know what you're looking for. It's a trick question because you should have different portions of your portfolio that you're trying to allocate for. It's like a fantasy basketball team, right? There's 5 players. There's a couple guard spots, a couple forward spots, and a center spot. You come up for the draft. you don't always pick the best player. At some point, you're trying to just pick the best person for your team. Now, if you're a new investor, then yeah, maybe you're just picking the best player. But most of you guys out there have already an idea of what your asset allocation mix is, and are just picking positional players at that point, if I'm using this analogy correctly. Just talk with us. If you're new to the game, we can take a look at the last deal and go through it with you and show you why we like the deal so much. There is the syndication e-course in there. I would also say take a look at the number section in there, at least understanding what are the big things that we look at from an underwriting perspective. So you're aware and you can get into a conversation with us or other people or other deals that you're looking at. Hopefully, it takes some action in 2026. I do think 4 or 5 years from now, we're going to look back in this 2026 at this video and say, shoot, probably should have done a lot more. Just like how people said 2012 to 2014, I wish I bought a lot more of that stuff back then. I do think we're in the same inflection point in that market cycle, but one market cycle prior. If you guys haven't interacted with me yet, book a call with me. If you haven't interacted or if you're looking to deploy capital, shoot us an email, team@thewealthelevator.com. We'll get you on the calendar. And yeah, here's to 2026.